Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning, folks. Here's your look at how markets are setting up for tonight on Wall Street. No action last night because of Memorial Day. Futures are looking up. The Dow Jones Industrial Average is higher by 450 points, 1.1% higher. S&P 500 futures climbing 1.2%. Nasdaq 100 futures up 1.4%. And all on the back of news that Donald Trump is going to push back the 50% levy deadline on the EU to July the 9th from June. So a bit of a can kicking down the road moment, and that follows a request from Ursula von der Leyen, the president of the European Commission. And this follows last week's proposal from Donald Trump of an import tax of 50% on the EU. So a bit of a U-turn moment in a short span of time. To help us figure out where things are going from here, we've got Mark Giambrone. He is the head of US Equities and portfolio manager analyst at Barrow, Hanley Global Investors. Mark, how are you doing today?
Good morning. Thanks for having me on.
Thanks for joining us for this conversation. Well, I've got a lot to talk about when it comes to the tariff situation. What do you take away from the latest move in the markets in response? It looks like kind of risk appetite back on again.
I do think the market views the tariff situation as an overall risk, potentially leading to not just inflation, but also recessionary pressures here in the U.S. And so, as you suggested earlier, kicking the can down the road with a 50% increase on the EU is viewed positively, with the hope that, of course, tariffs are really more of a negotiating tool than they are a policy, and that maybe something positive can come out of it during the time period of this delay.
Yeah, Mark, how optimistic are you? Because we are talking about can be kicked down the road. So for an investor, should you be going back into it right now with this lack of certainty?
Well, let me say that I agree with you that we're still in a period of uncertainty that is meaningful and will take some time to unravel, specifically around tariffs. I do think tariffs at the moment are clearly an overhang on the market, but there are some positive things also working underneath the tariff situation, which is a very large tax bill that just passed through the House and into the Senate that will probably give us some clarity in the second half of this year. And if possible, we'll also get some clarity around tariffs as time goes on. So at the moment, the biggest concern around tariffs, from my perspective, is that it's creating uncertainty for large capital allocators to make decisions, business decisions, meaning CEOs building new plants, hiring people, starting the next project. And really, the market might like the fact that we're kicking the can down the road, but it extends that uncertainty. And until we get some clarity around the rules, meaning whether there are going to be tariffs in place or not, clarity is important. Getting a budget and a tax bill put in place is important. Getting the Federal Reserve off of the sidelines and then pointing to tariffs as their largest concern is important. All those things will help the U.S. market, but they're several months off, frankly. And so I think we're probably in a trading pattern, positive and negatives around headlines, which is not really good for fundamentals. Ultimately, fundamentals will win out, and we should get through this period of uncertainty as we get into kind of the second half of the year. I hope, at latest into the new year.
Yeah, a couple of things to unpack there. We'll talk more about tax bill in just a bit. Right now, all the, lack of certainty, and you mentioned companies looking quite uncertain in terms of hiring, budgeting, and so on. For investors, what's the playbook here? Should they be rotating into more defensive names right now, like even alternative assets like gold?
I actually think that time has passed. And so I think defensive assets have already held up extremely well. I think it's time to accept that outside of a recession, which I still view as a low probability event, but even within a recession, if it comes, it'll be probably short-lived. I think it's time to start thinking about actively allocating to more risky assets, but there's no hurry. And so what I mean by that, if you're considering putting $1 to work, over the remainder of the next several months, I think that makes good sense. I think chasing gold or chasing defensive assets at this point is a little late in the game.
Okay, so looking at where we are for some of the tech shares, Apple has been in focus in the past week because of Trump's comments on Truth Social. The iPhones sold in the US must be made in the US. So there's some pressure there. So what sort of, riskier assets are you looking at? Is it in the AI space, tech space?
I do think the AI space is an excellent place to be looking to allocate capital. I do think the AI CapEx cycle is in its early stages, even though we've had some concern around, a few things that have happened, whether it's DeepSeek or it's Microsoft pulling back from some CapEx, then I still think there's significant growth there in earlier innings. So yes, that's one place. Apple is unique, and the Mag 7 may not be the place to be looking. I would suggest that below the Mag 7 may be the place to be looking in terms of thinking about AI, technology, riskier assets. And one of the reasons why is because they're the ones spending the money. And oftentimes when you're in a CapEx cycle and returns tend to be lower, or certainly free cash flow tends to be lower in these CapEx cycles, it's often better to look as to where the money is going than the person that's spending it. And clearly the Mag 7 are those that are spending versus where the cash is going. Those would be the places I would look first.
All right, talking about spending, that's when I think, can bring in the tax bill. So on site, like you pointed out, it's going to be good news down the road to some extent, lower taxes for companies. But there are also concerns about how this is going to balloon the deficit, and that's been reflected in the bond yields. How do you square this off? Is it going to be more pros or more cons?
Well, let me start by saying that the bond yields are a concern. And I don't want to, I want to use that as my greatest, if you ask me what's going to go bump in the night and what do I worry about, that's what I worry about. So yields going higher are counterintuitive here for me in terms of wanting to put money to work in risk assets. And I think it's around a couple things. One could potentially be positive, and the market could be forecasting that we'll be getting into a growth cycle where we have growth and therefore higher rates could be okay in that particular environment, around a tax bill that is stimulative, as you suggested. The other, unfortunately, could be that we have no fiscal control in the U.S. and the expectation of a budget, either surplus or at least not a significant deficit, and a debt ceiling that would be contained, doesn't seem as probable as it did when the bill started. And if that's true, and we have a lack of fiscal conservativeness here in the U.S., and that's reflected in the bond market, that will be negative for the long term. I do think, by the way, when we talk about kicking the can down the road, President Trump is taking his sort of clues from the bond market, and rising rates is actually impacting his decisions and weakening his hand, in my opinion. And that, to me, would be the one big concern about the U.S. market, is if that got out of control. I do think the tax bill will be positive overall. It's not finished yet. But the bill that passed through the House then goes to the Senate. The bill that passed through the House doesn't do much to address deficit spending or an increase in the overall debt levels. That's disappointing, I think, in terms of what the market would like. And we'll see what the Senate now does. The Senate has been talking about the fact that the bill needs more teeth related to lowering the deficit and lowering the overall debt levels. And so I'm hopeful that may be the case. But I am also concerned, as you suggested, that if it doesn't accomplish that particular goal, rates will be higher, and higher rates will lead to lower economic activity.
All right, a great overview of all the concerns and scenarios to look out for in the coming weeks. And there's been conversation with Mark Giambrone. He is the head of U.S. Equities and portfolio manager analyst at Barrow, Hanley Global Investors. Mark, always a pleasure chatting with you. Thanks for your time today.
Thank you. Same here. Have a good rest of the day.
Catch up again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.